we're alerting you before we actually begin this. Okay, great. Welcome again, everyone, to this, our second episode, level 2 of our MSME financial management training. We're really delighted that you have joined us today, and we hope that this session will be very valuable to each one of you. Our purpose for doing this is to support our businesses with financial literacy, and ultimately to ensure that our businesses are able to access finance. So once again, we really thank you for joining this. And I would like to introduce our partners in this process. Our partners are CREAD, and today Elijah Libler of CREAD will be presenting to us, as you saw in level 1, on record keeping. Also part of this team is Brent Barnett, who is the economic growth lead at CREAD, and he'll also be able to give a few remarks before we begin this process. So once again, DAIC is extremely pleased to support our businesses in enhancing financial literacy and access to finance, and we look forward to your feedback even as we continue supporting you. So Brent, we hand over to you so you could say a few words, and then we'll begin the session with Elijah.
Terrific. Thank you very much, Lizra, and welcome everyone. I'm assuming we have here a group of people who have participated in the first session, and you all did a great job on the exam. Well done on making it through. We hope that the session proved useful, and I know that you'll find this session useful as well. The information that Eli's pulled together is really quite interesting, and I think will give you a really good grasp on some of the key concepts that are necessary in terms of getting a better grasp of managing the finances of your business. We will look forward to your feedback and to your comments as the session progresses, and we hope to see everyone on Module 3. Thank you.
Great. Thank you so much, Brent, for this short remark. And at this time, we move over to the person that you're long waiting for, Mr. Elijah Libler.
Thank you, Lizra, and welcome everybody again. It's, I must say, it's a delight that we can move on to level 2 of our training. I would like to say congratulations to all of you who took the time out and went through the material and successfully completed the test that got you into level 2. And today is going to be even more exciting than the first time as we move into a new training or level 2 training. Lizra, I believe you will be presenting the slides as I go along.
Okay, sure. I'll present the slides, and you let me know when you'd like to start the business intro survey as well.
Yes. All right, so as Lizra gets this going, I was looking through the list to familiarize myself with the persons there, and there are a few persons that I know, but I'm hoping that at the end of our trainings, I'll get to know all of you much better. So today we want to make the training as interactive as we can. So there are a few polling questions that we will highlight that you take just a few seconds to do. The questions are not intimidating at all. They are very simple, but just so that we can assess your understanding as we go along through our training today. Before we move into the training itself, there's a first poll. We'd like to know a little bit more about, do a little profile of your company and just to know what your company is about, what industry it's in, the size of your company, basic information as that. So Lizra is about to put the first poll up so that we get to know your company a little bit better. So just take a few seconds to answer the questions. Just select the one that best fits your company so we have an understanding of who you are and what company you represent. Okay, Lizra, how is our polling progress going on?
So far, we have a number of persons responding. There are 19 out of 22 persons who voted, so that's really excellent. We only have 3 persons who didn't vote, so you let me know when you would want to end the poll and I could share the results.
Okay, let's just give them probably just a couple more seconds.
So we had the first, which sector do you operate in? Secondly, how long have you been in business? And thirdly, do you keep financial records? It's quite interesting though that many of the businesses clicked order services. So perhaps what we could also do is ask the participants to share in the chat what type of service they're actually involved in. So it would help us to understand, seeing that this is the one that's chosen the most.
Excellent idea, Lizra. Yes, so feel free to jot in the chat, you know, as it is, as you chose order services, probably could be a little more specific so we understand the nature of your business.
Great. Do you want me to share the results now?
That would be nice. Thank you.
Okay, great.
All right, so we have a few from the agro-processing, from tourism, and as we said, majority is from other services. So please feel free to share in the chat the nature of your business that can help us to understand. How long have you been in business? We have 11% that are not yet, so you're thinking of that. Less than a year, so we have startup, okay. 2 to 5 years, 42%, and 6 to 10 years, 16%, and within this. So pretty much the majority of our participants here, your businesses are either 5 years or less. All right, so we're hoping that this training is definitely going to be relevant to you, and I'm sure for those whose businesses are beyond 5 years, there are contents in this training that's going to be relevant as well. Let's look at your financial record keeping habits. Okay, all the time, 42 and 47 sometimes, and not at all. Okay, I'm very concerned with that 11%, not at all. You know, if you are in business and you're not keeping records, that is very scary. That is very scary. So I'm hoping that this training is going to change your mind, and I'm probably just thinking on the fly, Lizra, but we hope that we can probably later on with a follow-up poll kind of ask persons that question again in terms of whether they intend to keep financial records, and we'll see if our training had any impression or influence on getting them to change their record-keeping habits. Okay, so we have 42%, which is pretty good, of persons who are keeping records. That's very good. So as we continue, just to kind of recap on what we did, of course, the outline of our level 1, level 2, and level 3. If you would go to the next slide, please. Okay, so you will remember just last month we covered startup, where we looked at starting a business and the different types of the business, looked at statutory legal obligations and basic financial management. So in level 2, which is what we're going to cover today, we are going to look at record keeping. And this is why the polling questions were very specific to your record keeping and to understand the type of business that you're in. Today, we're hoping to cover 3 core areas or 3 objectives, which is the importance of record keeping, the basic records, and the fundamentals of financial statements. In level 3, we'll be looking deeper into the accounting system itself in terms of choosing it, setting it up, posting transactions, looking at end of year or end of financial period adjustments, and financial reporting. Okay, so let's go into our level 2 record keeping. Let's look at the overall objective of the training, its entirety, what the objectives of the free training it is really to help you to improve your financial management skills, to get you to prepare better plans strategically for your business in order to maximize your wealth and also to grow your business. Another of the objective would be enhancing your access to finance. That's one of the key areas to enable you to access finance. And the other is to build a more resilient business. You have a resilient plan, and that your business is well structured to go beyond 5 years and to grow into a very successful business. So that's the overall objective. Let us now narrow down onto level 2, record keeping, on slide 4. Okay, and what our objective for today would be is to understand the importance of our record keeping, have a basic bookkeeping, understand the basic bookkeeping terms. I'm sure a lot of the terms that we will use might be familiar to you. We'll also ensure that we can have a fundamental knowledge of bookkeeping and the process of bookkeeping. And the fourth objective is to understand the effects of bookkeeping as it relates to financial statements. And today we're going to cover three key areas. First, we are looking at bookkeeping terms, the process of bookkeeping, and financial statements. All right, so as we move into the bookkeeping terms, we first of all would want to understand what bookkeeping is all about. And we would also want to ask, well, what's the relevance of bookkeeping to my company? How relevant is it? Does it add value to my company? How important is bookkeeping? So as I'm hoping that this training is really going to get you to really value your bookkeeping and see how important it is to the survival of your business, to growing the business, to its profitability, and for that business to continue, even as a legacy that you can pass on to those that you wish. So in considering bookkeeping, what is bookkeeping? Well, bookkeeping is really a process. It's really the way that we record transactions of a business. And how do we record transactions of business? Some persons have this shoebox approach where they would purchase items, gather all the receipts, and just stuff them into a shoebox or stuff them into a plastic bag or what have you. Some persons don't even bother to keep records. As we see, 11% of the persons are not keeping records at all. But it's very, very important that you keep records, and not just keeping those records, but they must be kept in a very systematic manner. And what we mean by that is that your record keeping should be kept in a way that is chronological, with time, with date. For example, all your purchases, all your sales that you have done for the month of June should be kept in a systematic order, in a chronological order that is easy, that you can follow and retrieve. So if it is that you need to refer to something because of the way that it is set up systematically, it is very easy for you to retrieve that information. And the reason for that is when you're doing record keeping, the purpose of it is so that it can serve as information that you can refer to in the future. And a lot of times your record keeping might also be required by law. If the Inland Revenue decides to audit your books, or if there's any dispute legally that you have to present evidence in court, your bookkeeping records are very critical at that stage. It is also important that when you are looking to rather pitch for an investor, or you're looking to approach the bank for lending, they're going to need to be interested in your bookkeeping records. Okay, so bookkeeping is very, very important. So it's recording these transactions in a very systematic way, in a very analytical way that you can use it to not just calculate the numbers, but to get these numbers and interpret them into how realistic terms as to how you can plan, make those strategic plans for your business, okay? And also, the basics of a firm's accounting system is is really the foundation of what bookkeeping is. You cannot have an accounting system without bookkeeping. So bookkeeping, basically, if we were to compare it in the analogy of a building, you can't have a building without a foundation. The foundation must be established. And that is the principle of the concept that you must see bookkeeping as that foundation that starts you off into your accounting system. And if bookkeeping is your foundation, it means that the quality of your bookkeeping will determine the quality of your accounting system as well. If your bookkeeping has a lot of errors or it's incomplete, you're missing information, then guess what? Your financial statements that you will generate are going to be incomplete. They are not going to be accurate. So bookkeeping is critical. And as we said, the importance of that is so that you can continue functioning. You want to ensure that the day-to-day operations of your business are well met, are well funded, are well managed, and your bookkeeping, all the data that you're using is that tool that's going to help you. It's going to help you to make better operation decisions, whether you have sufficient cash, or how high are your stock levels, how low are your stock levels, when should you reorder, how long should you take to reorder, all of these things. What is the pattern, the buying and the buying behaviors of my customers? All of that information and analytical analysis of your business can only be done if you have that foundation, which is your bookkeeping, keeping those transactions. Making better investment decisions, definitely you're going to need your records in order to take these decisions. And of course, to preparing accurate and complete financial statements. Okay, next slide, please. Okay. So as we go into the terms, you might have heard of something called single bookkeeping. So it's like a single entry of bookkeeping. And as the name, introduces itself, that's what it means, is that there's a single entry. There are two types of ways to keep books. You could either keep your books in a single entry manner, or you could keep it in a double entry manner. And so let us first speak about the single entry bookkeeping style. It is really where you record each transaction as you would on something such as a check register. And you would probably have one column. If you look onto your slide, onto the top, you would see a cash register example. Here, someone is purchasing a computer. And this is what we refer to as a single entry bookkeeping system. Only the purchase of the computer is recorded. And with the single entry system, what it bears in mind, or it assumes that every transaction is a cash transaction. And what do I mean by that? It means that purchasing the computer will only be recorded when actual cash is exchanged for that computer. And that is what single entry does. It makes the assumption that you are keeping your books on a cash accounting basis, okay? And there's another accounting basis which we'll speak about when we get to double entry system. But for the single entry, it assumes that every transaction is done by cash. And it's very simple, very easy. That's one of the advantages of the single entry. It's very simple, very easy to use. Who is this type of entry suitable for? Well, it's suitable for somebody who has a very, small business, very micro level business. Even small businesses, many of the small businesses do not really use that type of system. It is very, very simple, and it assumes that all of your transactions are going to be on a cash basis. Also, it is for business that have very low transactions. So it's more like for a business that is more, or an entrepreneur who is doing a business more as a hobby, who has very low volumes of transaction, and who probably just want to record transactions as it is done on a cash basis. Some of the disadvantages, though, is that the single entry system does not record things like your inventory, it would not track things as payables or receivables. And the reason why it would not track payables and receivables is because payables and receivables are principles that are formed under what we call the accrual basis. And to put it in simpler terms, the accrual basis refers to transactions that are done on credit. For example, if in our scenario, the person purchased a computer on credit to pay later, that would be as an accrual basis, okay? So the single entry, because it assumes that everything is at a cash level, it would not be able to acknowledge transactions that are done with payables or receivables. Neither would it be able to recognize your assets and your liabilities. And that's a big problem because you as an entrepreneur would like to ensure that you have a balance sheet. And in your balance sheet, of course, you have your assets and your liabilities. So that's the downfall of the single entry. As I said, it's more recommended for very small businesses, businesses with low volumes, businesses that are operating on a strictly cash basis. Okay, let's now look at double entry. So the double entry bookkeeping system is, as the name suggests, there are 2 entries for each transaction. So in the double entry bookkeeping scenario, every transaction would have at least 2 entries. Now with this type of system, each account would have 2 columns. If you look up, you could see we have an example just above. You would notice that to your left, there is a cash account. And with the cash account, there's 2 columns, which is the debit and the credit. And to your right, you would notice there's an asset account. And it also has a debit and a credit. But if you notice, the cash account has an entry recorded on the credit column, whereas the asset account has the entry recorded on the debit column. And this is what we talk about a double entry bookkeeping system. It is where every transaction has at least 2 entries. So in the same example that we used for the single entry, where we only had 1 entry recording the computer and the cash, here we're recording it where cash is being given up. Okay, we are spending cash so that we can acquire a computer. So what the entrepreneur is doing in this scenario, they are recording that they are giving cash. So cash is coming out of their account, their cash account. As we can see, it's a credit. And the narration there and the detail there is to say that what it is that the cash is being spent on, which is the computer. And in the asset account, we see that the computer is also the narrative, but it's on the debit side, that $1,000 on the debit side. So what we're saying that we have exchanged cash of the value of 1,000 for the equivalent of an asset or the computer for 1,000. And that is what double entry is all about. Double entry has the theory that everything must balance, and there must be balance. So whatever you do to one account, so if I debit an account, I must in return credit another account. And that's the relation of a double entry system. That system is very popular. It's widely used, not just by big companies, but even small companies. And I would recommend using the double entry system for your company, no matter how small it is, because what it does, it helps you to keep, as we can see, it helps you to keep track of your inventory. It helps you to keep track of your trade receivables, that are people who are owing you. It helps you to keep track of your payables. These are people that you owe money to. It helps you to keep track of your assets and your liabilities, things that you own, things that you owe, all right? And also, it provides a greater level of detail for your financial statement. Remember what we said about bookkeeping, that it is a foundation that impacts your financial statements. And so using the double entry bookkeeping system is highly recommended. It is a bit more complex, a little bit more complicated than the single entry, but definitely it provides a lot more detail for you as a business owner. And you know, as this course is very fundamental, but the complexity of the bookkeeping you are not going to learn from this course. However, if you have an accountant, which would be very versed in knowing how to transact and record every transaction for you. But if you have this fundamental understanding of what double entry is, which is, okay, I debit one thing, I credit the other, then that's going to help you to understand how transactions are to be recorded as you go along. Okay, let's move now to next slide. Okay, so you did hear me mention about assets, and we just want to define that term. Many of you might be familiar with that, but just to ensure that everybody's on the same wavelength. There are different types of assets, but generally, an asset can be considered like a resource which a business will enjoy positive economic benefits from. And to put it more simply, it's basically something that you own, okay? Something that you own that generates cash or generates profits for your business, okay? That's what an asset is. And now there are different categories of assets. We have intangible assets. These are assets that we can see with the naked eye. They're not physical that you can touch. And what are some of these intangible assets? We have things like trademarks, we have patents, like the Coca-Cola sign, the Apple sign. All of these are trademarks and patents that we use. We have software, like the very software that we're using, Zoom, to bring this meeting across. These are intangible assets. So the softwares that companies use to generate revenue for their self and make profits on are considered assets. They are just intangible. And the tangible assets, of course, we know the obvious, like our land, like buildings, like computers, motor vehicles. All of these are tangible assets that we have. Assets can also be broken down into what we consider current assets and non-current assets. And by current assets, we mean assets that can be converted into cash, can be liquidated within 12 months or less, okay? Whereas non-current assets is the opposite. These are assets that are going to last longer than a year. That's going to take longer than a year to turn into cash. And so some of the current assets that are very common are things such as cash, whether it's petty cash, whether it's cash in hand, whether it's cash at your bank, short-term deposits. We also have inventory, whatever products that you're selling. This is considered your assets, and they're classified on the inventory. We also have trade receivables that we mentioned earlier. And trade receivables are really persons that you sell to on credit. And these are your assets because it is persons that you have transacted with, you have given your product to on credit, and they have promised to pay at a later date. So you're expecting cash from them. So these assets, these current assets, have the nature or the tendency to convert into cash quicker. And we normally describe these current assets as assets which can convert into cash in less than 1 year. Okay, and the non-current assets like land and building, which companies normally purchase as the fixed assets, or better known as non-current assets, are used in the day-to-day operations of the business. Okay, so you're working, you probably need to build a building, you purchase the land, you erect the building as a factory where you can process your goods and services. And these assets would have a longer nature. They would turn profits for you over a longer period of time. Okay, and that's what is meant by the classifications of assets. So let's now move to the next slide. And just before we do, Lisa, I just want to ensure that, so if you could come back to slide 9, I just want to ensure that everybody has, a fair understanding of what an asset is. If you could do the poll that asks them to choose a list of assets. Okay, so let's just take a few seconds to just answer this poll real quick. Okay, so it's asking you to choose the assets from the list. Okay, so there you can have more than one choice and choose all those that you think are assets. We'll just take a few seconds to do that. Okay, Lizra, how is our progress going with the poll?
So far, we have 15 of 28.
Okay, just
guess
give
28.
about 10 more seconds.
Yeah. If we get at least 2 more persons,
Yes.
we have 18, 19 now. Just 1 more.
Oh, great.
Okay, we have 20. So I will end it now and I'll share it.
Yes, thank you. All right, thank you very much. All right, so we are well, first of all, let's start with business loan. That one should be very obvious. The word at the end says loan, so it's something that you owe. So definitely it's not going to be an asset. As we said, assets are things that we own. Property, plant, and equipment, definitely, that's an asset. Inventory, definitely. Overdraft, they're very interesting. Somebody thinks that overdraft is an asset. Well, actually, it's not. It's not an asset. It's money actually that you owe to the bank, okay? And so it's like a credit line that the bank allows to you to go over whatever your credit limit is. It would extend your credit limit. So an overdraft would not be considered an asset. Cash at bank, definitely it is. All right, so I noticed some persons or most persons choose property, plant, and equipment because they are familiar with that. But inventory is definitely an asset, and cash at bank is also an asset. Okay, thank you. All right, so we're going to move now to the next slide, and we're speaking about liabilities. So we spoke about assets, now we're speaking about liabilities. And to put it simply, liabilities are quite the opposite of what we just spoke about. So with assets, they are things that we own, but with liabilities, these are things that we owe. So we owe this debt to persons, to other persons, okay? So they are basically, in definition, to transfer economic benefit due to past events. So we are transacting, and in our transaction, we're transferring that benefit to someone else. So let us look, for example, at buying a computer. In our example earlier on, if we had purchased that computer on credit, it would mean that something's being transferred to us. We would not have transferred cash because we're getting it on credit, we're paying later. So what would have happened in our double entry system is that we would have, or in our asset account, we would have debited our asset account, which says that we have received that computer. However, what account would be credited? Well, it can't be the cash because we're not paying cash right away. We would have to credit what we call a trade payables. Okay, so we credit a trade payables account. As you can see on the liabilities on the current assets, we have trade payables. And that would be for persons who will supply goods and services to you on a credit basis. Okay, whether your credit basis is for 15 days or 30 days or 60 days, what have you. So liabilities, just think of it very basic, that liabilities are things that my business owe to others, owe to my suppliers or my service providers. Okay. Just as assets, liabilities can be broken into different categories. We have liabilities that are current, and it takes the same measurement of time just as an asset. And what I mean by that is any current asset is defined as a current asset when that debt is due within 12 months or sooner. Okay, so where a debt is due within 12 months or sooner, it is referred to as a current asset. And trade payables, your suppliers might, as I said, allow you 30 days to repay, which is less than 12 months. Your bank overdraft, the bank would allow you to overdraw on your account. However, they would give you a certain period of time, which is usually less than 12 months, to repay that overdrawn balance. Okay, things such as your tax payable, if you're owing the government, you're expected to pay within 12 months, you know, to settle within a couple of months of you owing them. Okay, so all of these can be considered as current liabilities. Non-current liabilities carries the same measurement as our non-current assets. It takes more than 1 year, more than 12 months or accounting period to be repaid. So things like a long-term loan, many times you would approach a bank and the bank might give you a payback period of maybe 5 years or 10 years, depending on the nature of the loan and all of that, and you know the risk matrix and all of that will determine how long they give you to pay back. But most times your long-term loans are going to exceed 12 months, and so they would fall under the category of a non-current asset. We have deferred tax, where taxes are deferred to be paid later beyond 12 months, and these will fall under non-current assets. You also have long-term leases, where you're leasing probably land or property. Probably you want to open up a factory and you're leasing the property for 30 years or 20 years. All of these are considered as non-current assets, or you could also call them non-current liabilities, or you can also refer to them as long-term liabilities. So just think basic that assets are what I owe and liabilities are assets are what I own and liabilities are what I own. Okay, and if you think of it that way, it gives you a better understanding of what liabilities are. So just to ensure that we have a good understanding of liabilities, let's do another poll where we're going to choose what we think are the liabilities on the list. Do we have 20 response?
Yes, it came in pretty quickly this time. No, we have 24 responses, so we're good.
Great, excellent, excellent. All right, and I was just having a very quick glance at our chat comments here, and I noticed that some persons are saying that they're restricted to only choosing one answer, and that is probably why we're having the the responses where some are higher than the other. Okay, so we do apologize for that if it's not allowing you to choose more than one. Okay, so a business loan, definitely. I think majority of persons says definitely that this is a liability, and yes, that is true. A deposit savings, nobody thinks that it is, and you're right. This is not a liability, it is an asset. Trade payables, yep, that is a liability, and trade receivables, nope. So definitely, we have A students in our training. Everybody understands the fundamentals and the differences between assets and liabilities. Excellent. Okay, thank you. Okay, let's continue to our next slide. Okay, so we spoke about assets, we spoke about liabilities, and there's something I want to speak about, and that is equity. All right, so equity, if we think of our assets and look at you did? Okay. If we think of our assets, if you look at your scenario here, you would see on the assets, there's cash and there's a ladder and there's an equal sign that says there's a bank is giving a loan. So we already know what an asset is, something that we own, and liabilities is what we owe. If we were to look at the formula, the equation here, we would see that assets equal liabilities plus equity. And just to do a very small, maths equation, if we were to minus our liabilities from our assets, we would be left with our equity, okay? So assets equal liabilities plus equity. What does that mean to us? It means that what we own, subtract what we owe, whatever we have left is our equity. So let me put it in a very simple way for us. If you have a $50 and you are to enter into a supermarket, at current, you have $50 and that's your asset in your pocket of $50. And then you pick a few grocery items and it comes to $45. That is what you owe and you have to pay. When you have paid over the counter, you'll be left with $5, and that is your equity. So basically in the business world, all of the resources that the business owns, subtract what it owes, what is left is the equity. The equity is also the net worth or the value of the business. So it tells us what. So if you want to know, how much is my business worth? Then a very simple calculation would be to calculate up and tally up to a value of all of your assets, what they're worth, and then also tally up all of what you're owing, all your debt, and subtract the debt from the asset. And if it is that you remain a positive number, it means that your business has value. Now, if it is that you own, the value of what you own is less than what you owe, it means that your business doesn't have value. As a matter of fact, the value is negative. So this helps you as an entrepreneur to really keep track in terms of your assets in comparison to your liabilities and how much that your business is owned. Of course, this is just a very simple way of looking at it. And there are many other components that goes into value in a business. But the basic rules of using a accounting equation, which is asset is equal to liability plus equity, helps you to understand. So just to recap on this point, that the equity is really the net of our asset after deducting our liabilities. And what remains tells us what the value of our business is. If somebody was to invest in your business or to buy a partnership in your business, that is one of the things they would be concerned about. It's not just looking at the assets, but you also have to look at, okay, what does the business owe to other persons and to know what the net worth is. Now, with the accounting equation, that helps us with bookkeeping. Remember, we spoke about the double entry system, and that is where the accounting system kind of works hand in hand with the double entry book system, where it helps us to see that there is an equation that should always balance. So in order for us to acquire the computer, something had to give. And what gave was that we purchased it by cash. And so we had to give up cash in order to get an asset. Now, if we were to consider the equation, well, the left side of the equation under the asset would be only what would be affected, because our cash would be reduced and then we would have received a computer. There can also be another scenario. What if we had purchased the computer by credit? Well, we approached the bank and we said, look, I need a computer for my business. It's going to cost me $1,000. The bank is going to issue you a loan for $1,000. And you're going to use that to purchase your computer. And what would have happened to balance off, you would have your asset, which the computer is, at $1,000, and you would have liabilities, which would be at $1,000, and that would create a balance, okay? And so that is a basic way to think of the accounting equation. All right, so we have covered what an asset is, we have covered what record keeping is, we have covered what liabilities is, we have covered what equity is, and we have also spoken about the accounting equation. Now, let us move on. Before we do, Liz, I believe there's another poll for the equity, and I just want to ensure that everybody knows or understand the principle of the accounting equation. Okay, so this one requires a little bit of maths, not much. Don't get scared. I know some persons are very scared of numbers. Don't get scared. It's a very easy calculation. So in this scenario, it's asking you that if a company owns total assets of 10,000 and it owes total liabilities of 8,500, how much is the business worth? Okay, so just if you could respond to that quickly. And in this scenario, it's only one answer that you have to choose.
Yeah, one answer, it was edited again, but then there are two of them that says 18.5, so please pardon this.
Oh, that must be a typo. Okay, so we are not going to penalize you if you choose 18.5 in the first instance or the second one. You just have to choose one answer.
We've had only 7 persons respond thus far.
7.
8 now. 10.
I hope the numbers are not scaring you.
We have 12 now.
Well, I think we have a problem, Lisa. Yeah, there's a problem for a selection, but let's just see how many persons we have.
We have 29, well, 15 answered now. I think
Okay.
that's good. There are a few persons who sign in on 2 devices, so.
Okay. All right, so I think there's a problem with our selections, the options that we have there. So I'm going to allow somebody to tell us what the problem is. If you would like to unmute your mic and speak, or you would like to type it in, go right ahead.
Yeah, if anyone would want to speak, they could raise their hand and we would unmute the mic. Okay, so there's some messages in the chat.
All right, so I'm thinking that a lot of persons are getting it correct. I can see some of the messages.
Okay, so I asked
would anybody want to unmute and
yes, Lynn?
Good afternoon.
Good afternoon.
Well, the option wasn't part of the selection, so that was the kind of trick question. So you had to actually calculate it, and you get 1,500.
That is correct. All right, that is correct. So as we said, thank you, Lynn. As we said, the total assets is the total amount that you own, which is 10,000, and you're owing 8,500. Well, if you subtract that, it's going to leave you 1,500, which is the net worth, or what's the worth of the business. Okay, so that's a very quick way to get an idea of what your business is worth. So in your spare time, probably do that. Just calculate what you own and what it comes to, what the value is, and what you owe to people, and see what your equity looks like. Okay. All right, so we have just looked at the first section. We're going to section 2. We're going to talk now about bookkeeping processes. Okay, we've already defined what bookkeeping is, and we talk about recording your transaction in a very systematic and analytic way, where we can use that information to now generate very quality and decision-driven information and reports. Now let us look at how our bookkeeping processes are. And there are 4 main processes in our bookkeeping. We must first analyze our transactions. We must also consider when we're doing bookkeeping, we must keep in mind the accounting equation, which we just did an exercise on. We must also categorize these transactions. And we must also consider the debit and the credit that we spoke about in double entry bookkeeping. Okay, so with the bookkeeping process, whenever a transaction, the business carries out a transaction, we have to think of these 4 processes, and every transaction is subjected to these 4 processes. Analyzing, okay, thinking about the accounting equation for that transaction, where do I categorize these accounts, and also what do I debit, what do I credit. Okay, so let's move now to looking at each of these processes in more detail. So let us consider analyzing the transaction. To analyze, we must think of 3 main elements. We must ask ourselves, is this transaction measurable? Who are the independent parties that are engaging in this transaction? And what is the source document? What is the supporting document that is included in this transaction? Analyzing transactions is the beginning towards bookkeeping process. And there, businesses engage in various types of events every day. So for example, you might have a bookstore who came up with an excellent idea of having, one of the authors of a well-written book to come in and sign off on that book. And, this might rope in a lot of customers. People might be very excited to meet that author in person. And what it does, it would stimulate and generate a lot of publicity for that company. And that company might draw a lot of persons into its store. But how can this event be measured? How are we going to measure that? So in this case, this event cannot be quantified. Yes, a lot of persons will come into the store, but it's not a reliable measure of that we can put into a bookkeeping system. So we need something that can be measured. So having like probably a publicity, having an ad, having a show is not an event that we can record in our books. What can we record in our books? It must be measurable. And by measurable, we mean something that can be quantified, that there is a monetary value that we can put to it. So if we go back to our example, if someone purchased a book from that bookstore, then the bookstore would be able to record that transaction, because by analyzing the transaction can be measurable. We can know what the cost of that book was to us, and we can also know what the selling price to that customer is. And we would be able to record that sale of that book because we have a monetary value. Where we don't have monetary values, we are unable to record that into our accounting system. And think of it, if something has no value or we cannot determine the value, it's pointless that it's entered into our accounting system. There might be events that are very substantial and this information are pertinent to the business. And there is a separate place for such information. But as we're speaking about bookkeeping in our accounting system, any event or transaction must be measurable in order for them to be considered as being recorded in the bookkeeping process. We also need independent parties. Whenever transactions are being recorded, we must know the parties that are transacting. We must have a name of that customer or a name of that supplier to whom the business is transacting. And that is very important for legal reasons. It is important for our own record keeping reasons. So whenever you're doing a transaction, and that's very important, think of it in terms of when you're transacting. If you're selling a product to someone, they might ask you for a receipt. And on that receipt, there must be a monetary measurable, which is a value. a description of what you're selling to the person and the value of that. You should also have the name of the person to whom you're selling, and of course the name of the company who is doing the selling, which is the independent parties. And there should be a source document. Some persons chose, I think 11% said that they don't keep records. And if you don't keep records, you are running your business blind. It's like you're putting, you know, tying your eye with a cloth and blinding yourself and trying to walk on a very thin line. And that is really dangerous to do, running a business without record keeping. So your source documents are very, very, very important in that they would be the legal document that you refer to. They would also be the document that you're going to use to build a very solid accounting system. So analyzing transaction begins with first ensuring that that transaction can be measured, we can quantify it, there's a monetary value. Also that we can identify the parties among whom or between whom the transaction is being taken place. And we can also have a source document that would validate and keep a record and document that transaction, okay? Another process in the bookkeeping next slide. The next one. Thank you. All right, and we spoke about it a little bit, but it's keeping in mind of the accounting equation. We did an exercise on that. We just spoke about assets equal liabilities and equity. So whenever we're doing a transaction, we must think in that mindset. We must always enter a transaction and record a transaction in our books, keeping in mind, okay, is this an asset? Is this a liability? Am I recording two assets? Am I giving up one asset in exchange for another? Am I reducing one liability and increasing another? Is this an equity? Is an investor buying shares into my business? Where does that transaction fall? So in having bookkeeping done, the accounting equation is very important in considering. So every transaction has to be kept in mind. If we continue from the illustration of the book, if we assume that books cost a total of, say, $5,000, think of the accounting equation. If we buy the books and we buy it on credit, well, what's going to happen? We're going to have our liabilities being increased by $5,000. And we're going to also have our assets being increased by $5,000 because we're buying books on credit. What are the two components in the equation that are going to be affected? Well, our assets. We are gaining books and we're buying on credit. So our assets are going to go up and so will also our liabilities go up and we'll keep a balance. So think of it that way. We could also have another scenario where the books are sold for $5,000 and we pay off the debt of that for $7,000 and we pay off the debt of that $5,000. Well, the entries would be for liabilities because we have paid off that outstanding invoice. Then we would have zero liabilities because we had paid it off. But guess what? We use cash to pay it off, but we have also increased by selling our books at $7,000. And what would happen now is that we have sold our books for more than it cost, and we're going to create what we call a profit, and profits would come on the equity. Okay, profits will come on the equity. And so our equation would become a little bit more complex, where we'd involve a transaction that has assets, liabilities, and equity. And this is very important in bookkeeping, that you have the basic knowledge of the asset, the liability, the equity, the relationship between them based on the accounting equation, so that when you are recording, that you record your transaction on the right side of your books, okay? Let's move on to the third process in bookkeeping. Okay, so we have to now categorize our transactions. There are 5 main account categories. There are 5 main account categories, and we have mentioned, I believe, all of them, if not in this training, but in the previous level 1. So one of the accounts that we're very familiar with is the asset account. And we spoke about the different examples of an asset, where we could have, cash, whether it's inventory and receivables. We also have the expense account, where we pay things such as wages, or payroll, where we have cost of goods sold, which is the cost of selling our goods. It could be insurance, it could be utilities, rent, whatever we pay, this is an expense. We have liabilities as well, which we mentioned about. We have equity, which we mentioned, and we have income, which really records our sales, any interest that we earn on our savings, or any miscellaneous income that we have, things that fall outside of our day-to-day regular sales. And so in accounting and in bookkeeping, we have these 5 main account types. And every transaction that we are recording, we must determine, okay, which of these accounts are we affecting? We have to have a knowledge as to, okay, what does this transaction fall under? Okay, so using our example of the bookstore, regarding the purchase of the books and the settlement of an invoice, when the purchase of the books would be recorded in a category of the assets, because it is our inventory that makes up what we have for selling. So we purchase the books, the asset account is going to be affected. It's going to be entered on the inventory. And also, if we purchase those books on credit, then we're going to also affect the liability account, which is going to fall under accounts payable. Okay, so that way we have an understanding. And if we have this fundamental understanding, when we're recording our transactions, we are able to do it correctly. When we make a payment, the outstanding invoice would be recorded in the checking account. So that means we're going to draw out from our cash. Our cash is going to give up, we're going to spend. So either if we write a check, it's going to come from our checking account under assets, or whether we pay it by cash. And of course, our liability is going to be reduced because we have paid off our debt. Okay, so with the double entry, each transaction is going to affect at least 2 accounts. Okay, there are transactions that are very complex that could probably affect all of the 5 accounts simultaneously. Okay, but just keeping it simple, and our example is very simple that you understand. That is very important to know your 5 main categories of accounts. There are asset accounts, there are expense, there's liability, there's equity, and there is income accounts. And these 5 areas, you need to know that when you're recording your transactions, which account that transaction falls within. And most times it would fall in at least 2 of these accounts, okay? Now, the final process of the bookkeeping is knowing when to debit and when to credit. In accounting, there is a rule that says debit the giver and credit the receiver. It means that whoever is receiving is debited, and whoever is giving or losing should be credited. And think of it. So here I have put forth the list on the different types of accounts. So we have assets. Well, the normal balance of an asset is a debit. Okay, an asset carries a debit balance, which means that it has a value. Okay, so an asset carries a debit balance. So if we're increasing our assets, that means we have to debit our assets. Well, if we are reducing our assets, then we do the opposite. We credit the asset. Okay. Our expenses normally carry a debit balance as well. And so if the balance or the account is carrying the normal balance of the account is what you would use to increase it. So we see here an expense has a normal balance of a debit. To increase our expense, we would debit it. If we were to reduce our expense, we would credit it. And that's the same principle, debit the giver, credit the receivable. And the dividends accounts carries a debit balance. Okay, losses also carry a debit balance. Liabilities carry a credit balance. Capital, credit balance. Revenue or sales, credit balance. Gains, credit balance. And so once you know the normal balance of these types of accounts, it is easy to know when you should increase or decrease. So because liabilities carries normally carries a credit balance, under my liability, what if I'm increasing my loan? What if I'm taking an additional loan to what I have? How do I increase my liabilities? Well, because liabilities has a credit balance, then I must credit liabilities to increase it. When I'm paying my loan, I am going to pay from my bank account, which is an asset account. So because my bank is giving, I'm going to credit my bank account. And my loan, I'm going to pay on my loan. I'm going to pay a portion of the principal of my loan. Well, the loan account is receiving payment from me. And so I would debit my liabilities. Okay, so understanding the debit and the credit helps you in balancing your accounts. In the debit and credit, the transactions must balance. And so if it does not balance, it means that you have made an error. And this is why the debit and credit is very important, because it helps you to identify any errors that have been made in your books. Okay, so these are the four main processes of bookkeeping. You analyze the transactions, ensuring that they're measurable, ensuring that you identify the independent parties among whom or between whom the transactions are being taken place. Also the source document, the records of these, the original records that document the transaction. And secondly, you bear in mind the accounting equation. You bear in mind the accounting equation once you're performing your bookkeeping or recording a transaction. Is it an asset? Is it two assets? Is it liabilities? Is it a combination of assets, liabilities, and equity? You also have to think about the categorization of your transaction. Okay, do I classify that? Is it going to fall on the balance sheet? Is it a revenue account? Is it an asset account? Is it an expense account or a liability account? You need to have this knowledge. And of course, once you are ready to actually record that into the system, you must know under your ledger and your trial balance that you need to know, okay, which account am I debiting, which account will I be crediting, okay? Okay, so I believe we have a poll, Lizra. Just so we get persons to know what the process is.
Yes, we do have a poll for this one.
I believe, hold on, Lizra, I think the question I wanted to poll is which entrepreneur is practicing the entire bookkeeping process.
Oh.
Let me see if we get this one. That's for slide number 12.
Okay, you want this one. Okay.
Okay, for this one, just read the scenarios and tell us which entrepreneur is practicing the entire bookkeeping process. Okay, and you choose one answer in this. How are we doing, Lisa?
Okay, so we have 23 of 28. The last time we had up to 24 persons, but
okay.
If you would like, we could end it now.
Yeah, that's fine. Okay. All right. It's quite obvious that Julia is the better entrepreneur in practicing the entire bookkeeping process. As we said, you analyze, and we see here that she creates different spreadsheets for sales and expense. So she has categorized her transactions. We see here that she also files her supporting documents and store them in chronological order. So she definitely is the one following the entire bookkeeping process. Tom and Sally are partially practicing proper bookkeeping. And so because of that, their financial statements would not reflect a true picture of the entire transactions of the business as it would for Julia. Thank you for participating. Okay, and we can move on. All right, so now we're looking at financial statement basics. There are many other types of or components of financial statements, but we are looking at the three main financial statements. The balance sheet, which carries a list of all our assets and liabilities and our equity that we spoke about. We have the income statement, also known as a profit and loss statement, that captures the revenue and expense and profit or loss of the business. And we have the statement of cash flows, which shows us how the business cash flow is doing. And it shows it in three main areas: in the operating activities, investing activities, and in financing activities. So with the balance sheet, it is really a list of what we own, what we owe, and what we have left. Okay, that is what it does. So I just want to speak a little about it before we move to the next slides, because the next slides are really showing us images of the balance sheet and just understanding a little of what it is. So remember, we spoke about the 5 main types of accounts. We spoke about the asset, we spoke about the liability, we spoke about equity, we spoke about revenue, we spoke about expenses. So with the balance sheet and the income statement, these 2 financial statements, your transactions are going to be, at the end results are going to end up there. Some things are going to be a balance sheet item, whereas some things are going to fall on the income statement. For example, if you are selling your product to a customer, then what's going to happen is your revenue is going to be affected. And so that transaction, when you do that bookkeeping, it's going to affect your income statement because you're making a sale. And your balance sheet is going to also going to be affected, because it means that you're drawing from your product, your inventory, you're selling some of your inventory in exchange for cash. And so your asset account is also going to be affected. So for this one transaction, you are impacting both the income statement and the balance sheet. And a cluster of these transactions over the years is what accumulates into your balance sheet and into your income statement. That's why it's very important that every single transaction is recorded properly, because the end result reflects the quality, the accuracy, and the completeness of your financial statements. The cash flow statement really tells us the relationship of cash. It tells us the different ways that a business generates cash, and these 3 areas that we will speak about. So with the cash flow statement, under operating activities, this area really speaks about how the business generates its cash, how the business is able to to yield the cash for it. So I want us to think of that, because most times as an entrepreneur, if you're approaching a bank, they would ask you, you need to visit an accountant and have the accountant do your financial statements. And most times they would ask for financial statements to be done for at least the last 3 years, assuming that you've been operating for long. And in the event that you're just starting up or you're barely a year, then they're going to ask for a business plan, which is a more comprehensive report of your business that would include financial statements, but they would be projected because you're newly existing. But where you are existing prior, the financial statement has to reflect your performance. The balance sheet really is referred to as a snapshot. It tells of a time when your business was at a certain point. The balance sheet, if you want to know the position of your business, the financial position of your business, you look towards the balance sheet. If you want to know the performance of your business, you look towards your income statement. Okay, if you want to know how liquid your business is, how is it able to generate cash, how is it in cash standings, you look towards your statement of cash flows. So let us go to the next slide, and we're going to look at a real life example of a balance sheet. Okay, so we're looking at a balance sheet, and as we said, basically it's really a list of all the things that we own and all the things we owe and what is worth. Okay, so from the balance sheet, we can see first of all that it's a bookstore. Notice at the top here, it gives us the financial year end, which is December 31st, 2019. And it also gives us the 2 previous years, okay, 2018 and 2017. When you're doing financial statements, it is recommended that you compare your years, because it's going to show you a trend, a pattern of what is happening. And here we will see that the business, if we look at the property on the non-current assets, which we say are assets that last beyond 12 months, we see the value of our property, plant, and equipment being the same all throughout the years. But below it, we see something called the accumulated depreciation. Depreciation is not a real cost. And by real, I mean it is not a cost that we can, with precision, say that that's the actual depreciation or wear and tear of the asset. But it's more as an estimate, but it has to be a realistic estimate. So depreciation really, it's where we make an assumption that over time, our fixed assets are going to be devalued by wear and tear, and they will depreciate over a period of time. Not all assets depreciate. Most times land appreciate rather than depreciate. But generally, we have things such as your motor vehicle would depreciate. And this here in the balance sheet is showing you, it is first of all showing you what the original cost of your property, plant, and equipment is. And over time, it is showing you how much it's been depreciated. So if you notice in December 2017, the depreciation charge was less than it would be in 2018 and 2019. And that makes sense because over time, it will continue to deplete and depreciate. Okay, and then you would see what is called your total non-current assets, which is the value after the assumption of removing your depreciation. Now, notice how in the balance sheet, how things are properly classified. We see we have the non-current assets and we list out what they are. We also have the current assets where we have the inventory, we have trade receivables and cash equivalents. Notice how systematic, notice how clear and how structured the balance sheet is well written, and we can compare it. That can only happen when our bookkeeping is done accurately. That can only happen when we keep in mind what we spoke about, knowing what to debit, knowing what to credit, knowing what account classification is required for each transaction. And that is the result of solid bookkeeping, okay? Also, if you look at your balance sheet, and it is called balance sheet for a reason, which is, if you take a look at your total assets, your total assets is 1.8 million. Well, jump down to the last line and take a look at your total equity and liabilities. It is also 1.8 million. Remember our accounting equation where we said that asset equals liabilities plus equity? Well, if you were to take your calculator and you would take the total equity, which is at 1.5 million, and you would add it to your total assets, sorry, your total liabilities, which is 0.3 million, then you would come up with that 1.8, which holds true to the accounting equation that assets equal liability plus equity. And we see here that this holds true for every single year of the financial statement of the bookstore. It shows here that the bookstore has gotten their bookkeeping right, and they are able to record everything correctly. So now from the balance sheet, there are a lot of things that we can extract, we can tell about within the balance sheet. It gives us a story of what is going on. There are things we can do. We can see, as I said, the worth of what is the worth of the business. Well, if we want to know how much it is worth, we can look at total equity, and we can see over the years, hey, is the business value going up? Is it going down? Is it fluctuating? Is it constant? All of this information. We can also see, okay, how much of our liabilities are we owing within a year? So we would look towards our current assets for that. For example, in December 2019, we could see that our total current liabilities was at 123,000. So these are debts that we must pay within a year. Then we have to ask ourselves, okay, is the business able to pay that debt within a year? Well, we can answer that question. If we go to current assets, we could look at current assets and we can see that there is a total of 1.2 million. So we have more than enough to meet our short-term debt with our short-term assets. And that's just some basic information that can be read off the balance sheet. Of course, depending on the user of the balance sheet, their information extraction would be biased to what they're looking at. If you're presenting your financial statement to a bank, the bank is definitely going to pay a lot of attention to your debt ratio. They're going to look at in comparison to how much long-term debt that you have. Do you have enough assets to cover those debts? So a lot of information can be pulled from your balance sheet. But what I want you to remember is that your balance sheet shows you all the things that you own and all the things you owe and the net worth of your business. Using annual comparisons of your balance sheet is very important because it shows you the trend that the business is taking, whether it's improving in value, whether its debt is high or low. All of this information helps you when you're looking at the balance sheet. Let me see, we have, I think we have two questions, Lizra, that I would like for us to poll as it relates to the balance sheet. I think the first question, okay. 7.
Which slide would it refer to?
Yes, so it refers to slide 18. I think there are two questions for slide 18.
Okay, so it's launched now?
Yes. Okay, so the first question asks, how much is the bookstore worth in 2018? Okay, so tell us how much is the bookstore worth in 2018? Okay, and I'm hoping that you have completed at least question 1. Question 2 asks you, what is paid in capital? What do you think paid in capital means?
Okay, so we only have 2 persons who have responded thus far.
Okay. Okay, let me help you. If we're looking at remember what we said represents what the company is worth. We said the equity tells us the value of the company. So if you look at your equity line under 2018, you should be able to see the worth of the company.
Okay, so we have 9 persons who responded thus far.
Okay. I believe somebody is having a difficulty to see the numbers on the screen. Not sure if they are probably using a small device.
Okay, maybe we could help with the numbers, but
yes.
How much is 123 bookstore within 123 bookstore within 2018? Multiple choice. 123 bookstore, the worth in 2018. We have 1,252,127. The second answer, 1,650,406. Third answer, 278,222, and the final answer, 398,279. Thus far, 14 persons have responded.
Okay. Can you see for question number 2 as well?
Yes, question two as well. We have 15 persons who have responded in total.
Okay. All right. I believe we can accept that for now. Okay. All right. So if we are still on our balance, great. Okay. So for the first question, if you selected the first answer, 1,252,127, then you are correct. In order to find out what's the worth of the business, we said that is the equity. So if you were to come down to December 2018, which is the middle column, and you would go down to the line that says total equity, there you would see what the worth of the company is. Remember our counting equation. If you were to pull out your calculator and you would total up punch in the numbers for the total assets for 2018, which is 1.6 million, and you would minus the total liabilities, which is 0.3 million, you would arrive at your total equity. Okay, so remember, assets less liabilities equates to equity, which is the net worth of the business. Okay. For the second question, paid in capital. And what is paid in capital? We said money is borrowed from the bank. Nope, that's not it. Money is contributed by the owners, and that is the correct answer. Paid in capital is contributions by the owners, the people who own the business, investing monies into the business. That is paid in capital. Okay, well done, excellent job. Okay, let's move now to our next slide, slide number 18. And this is our income statement. The same outline is followed as our balance sheet, having our 3 columns representing the 3 different years of trading. And here we see that it is well organized. It's in a very structured way that makes sense. We can see that the income or revenue, if you would, shows on the revenue, we can have different revenue streams. By this, we mean different things that generate money for us. So for the bookstore, they have decided to break up their revenue into 2 streams. So one with books and the other with stationaries. And when you're doing your record, you can also break up your revenue instead of putting everything into a total figure. For example, if you have different line of products, like with the bookstore, the primary product would be books, but they also sell stationaries. And so they would like to know how they're doing in their book sales and how they're doing in their stationery sales. That helps them to understand how each separate line might be performing. In this scenario, we see the sales being totaled at the end of total income. Direct cost. What is direct cost? What do we mean by direct cost? This is cost that is directly related to the products. It could be, for example, if you're like some persons are in the agro-processing, if you are buying ingredients to, say, if you're making soaps or you're making jams or juice, the ingredients that you buy, you purchase to make these products, to manufacture these products, these are going to be referred to as your direct cost, things that you can directly relate to producing that product. Here we see the bookstore has direct cost, also referred to as cost of sales or cost of goods sold, which really is the inventory where you have a certain amount of product that you have left, your purchases or products that you have purchased minus your inventory at the end of the year gives you your cost of goods sold, which means it's the total amount of cost. So for example, if you made sales of one, like in that case, in December, we see of 2019, that the bookstore was able to make total sales of 2.5 million. But that is not pure money that it's getting back. It actually cost the direct cost of 1 million. Okay, 1 million was the cost to sell these products. So it could be the cost of purchasing the books, the stationaries, and reselling them. Okay, so that's what we mean by direct cost. So here we have our total income, and if we remove or we reduce our income by our total cost of sales, we're left with what is known as your gross profit. Some people don't have stock, some people are not manufacturers, some people don't sell product, they sell services. There are instances where certain components are used to provide services, but where there are some companies that do not necessarily have what we call gross profit. They probably just have simply income and expense, but majority of companies would have that. And now your gross profit is your profit before your overheads, or what referred to as your operating expenses. And what are those? These are things like your wages, your probably promotion, advertising your products, paying insurance, transportation, covering utilities, bank charges, and what have you. All of these expenses would be your operating expenses, things that helps the business to function, to provide that product or service, but cannot be directly related to the product itself. Okay, once you have subtracted your total operating expenses from your gross profit, you are left with your profit. And some companies go about separating their or including depreciation and interest on the expenses, and some rather leave it out. Remember, I said that depreciation is not a true cost and it's more of an estimate. So for example, if you're going to a bank the bank is going to calculate what your profits are, and most times they would add back the depreciation, because simply depreciation is not a true cost. So they would add that back to your net profits to give a bigger figure of your profits. It is also wise to separate your interest, and interest here represents, assuming that you have a loan, the interest that you pay on that loan is sometimes separated. That helps persons to see what the true performance is in terms of what is the actual profit before you remove estimates of depreciation and you remove interest rates of financing a loan, okay? Of course, once you have subtracted your depreciation and your interest, you're left with what is called or referred to as your net profit. And that is your profit, your final profit figure of what you have made, okay? And now with your income statement, as with your balance sheet, where you compare it annually, you could study the trend, see what the performance is. Remember, as I said, the bank statement tells you the position of a company at a given period in time, whereas the income statement tells you of the performance. Performance is measured by whether the business is generating a profit or it's operating at a loss, okay? In our scenario, we see that every year the company has been generated profitably, and that tells us the picture of its performance. Okay, so if you want to know the performance of your business, and when your accountant draws up your income statement, you need to take a look and see how you're performing, look at the trends. It also helps you to look at areas of your costs, what expenses are higher than normal, or what areas you think that you're spending more than other areas. A lot of information can be extracted from these financial statements. But as I said, this is a very basic training, and we're not going to go into such detail for now. Okay, I believe we have a few questions just to ensure that we understand the income statement. We have 2 questions I would like us to, Lisa, if you could pull that. That's for slide 19. Okay, so the first one says, choose the statements. Okay, I'm hoping, Lisa, that they can choose more than one. Choose the statements that you think best reflects the performance of the bookstore. Okay, and we have the first option is sales are increasing each year. The second is purchases are decreasing each year. And the third, the bookstore has been operating profitably over the last 3 years. So choose the statements that you think best reflects the performance of the bookstore. Okay, and I believe you probably have completed the first question. So the second question asks you, how profitable was the bookstore in 2019? How profitable was the bookstore in 2019? We see the first option tells us that the bookstore operated profitably with $207,566. The second option says $234,506. And the third says $263,651. So if you would, please select the answer that you think best fits that.
Great, so we have 18 respondents now.
Okay.
Would
How
you
much?
like
Is it 8 or 18?
19? 19 now.
Oh, that's good. It's wonderful.
Okay, should we close it now or you?
Yes,
Okay.
I think that's good. Okay, if we could have the results.
So you're seeing the results, right?
No, I'm not able to see.
Yes, it says attendees are now viewing poll results.
I'm not sure. Okay. It's not showing on my screen though.
And I will share again. But it shows that for statement number 1, the answer that was chosen, 17 out of 19, says the bookstore has been operating profitably for over the last 3 years. 17 out of 19.
Okay, great. Great.
And we had 10, 10 responded that sales are increasing each year. 10 out of the 19, that's 53%, and 5% of the respondents said purchases are decreasing each year. So,
how many percent?
Excuse me?
How many percent said that purchases are decreasing?
5%.
Okay.
So we had 89 who said that the bookstore has been operating profitably for the last 3 years, and 53% for the first answer that sales are increasing each year, and finally 5% for the second response, that second option, that purchases are decreasing each year.
Okay, so if we look, thank you, Lizra, if we look at the income statement, we can see definitely at that the sales have been increasing. If we look from 2017 to 2019, we can see that the sales has been increasing. The bookstore is definitely doing something right. It's selling more books and stationaries. As it relates to the purchases have been decreased, let's look at purchases. If we look at purchases here, we see that purchases for 2017 is at 0.9 million and 1 million in 2018 and almost 1.1 million. So purchases are also increasing. And so B would not be one of the correct answers. For C, it says bookstore has been operating profitably over the last 3 years. Well, how do we measure the performance of the business? We can jump right down to our net profits. Let's look at our net profits. Our net profit for 2017 was at 207,000. Then it went up in 2018 to 234,000 and 263,000 in 2019. So definitely the business has been profitable over the 3 years. Okay, so if you chose first question and the third, you were correct. I think the next question asks, how profitable was the bookstore in 2019? Israel, do you have the result?
Yes, it's on the screen. I'm not sure if anyone else is seeing, but it says 74% of the respondents chose the third answer, 263,651. And we had 11% choosing 207,566, and 16% chose 234,506.
All right. So all 3 answers are also on the income statement, but we are looking specifically at the year 2019. So the correct answer would have been the third option, which is 263,000. Okay. And it's important that when you're looking at your records, that you pay attention to the correct year that you're looking at. But as we can appreciate, the income statement gives us a very good picture of the performance of the company. And it all points back to our bookkeeping and our processes. Okay, let's move on to the next slide. So we mentioned the financial statement, and the third one that we mentioned was the statement of cash flow. And so the statement of cash flow really tells about how cash is flowing, how the business is generating cash, and how it measures that. It's within 3 main areas. It measures the flow of cash based on the operating activities of the business. It also measures it based on investing activities and on financing activities. So let's speak about operating activities. First of all, operating activities speaks about the day-to-day operations. So In the example and our illustration that we're looking at with the bookstore, the day-to-day operations of the bookstore is going to be of that bookstore selling its books and its stationeries. So we're going to look at things such as, has inventory increased? Now, if inventory increased, we have to understand what cash means. There's a clear distinction between cash and profit. Some people, if I were to ask, why? Well, what do you rather? Do you prefer having a business with huge profits or having a very solid cash flow? And a lot of people might say, well, profits. Yes, all businesses are in business for generating profits, maximizing the wealth for itself and its owners. However, there's a saying that says cash is king, and there's a reason why this is said. So let's take, for example, the bookstore is making huge profits every year. What if it was running into cash flow problems? So it's selling its books, it's increasing its sales, but it's selling to customers and it's not taking notice, or it's not managing its cash well. So it's everybody's getting credit, they will pay later, but the bookstore is not mindful to send the invoices out or call the customers to pay on time. Then the bookstore might run into cash flow problems. A company will survive a longer period making a loss than having no cash, because cash is king. You need cash. Why? To meet your day-to-day operations. It would mean paying your employees. If you're running a bookstore and for 3 consecutive years, you have no money to pay your employees, I don't think you'll have a bookstore anymore, because persons are not going to work for 3 years without pay. They need to be paid, and that falls on the operating expenses. If you don't have money to pay your suppliers, well, they might give you 30 days to pay. And if you default on that payment, some suppliers might be gracious and give you goods on credit, but no supplier is going to constantly give you goods on credit for an extended period of time, okay? No banks are going to lend you money for an extended period of time where you're not generating cash or your cash flow is not being managed well. So although in your books, you might have a huge amount of sales that you're expecting persons to pay, but until you have that cash, actual cash at your disposal, you're going to have a difficulty in meeting your day-to-day operations, or what we refer to as your operating activities, such as things as paying your suppliers, paying your debts that are falling short, or your current liabilities, okay, and meeting your day-to-day expenses. So the operating activity is the biggest, most important area of your cash flow. It should be the area where your company is generating the largest amount of cash, okay? And as we can see for the bookstore, it's operating well. We can see that it's generating substantial amount of cash for its operating activities. Another area is your investing activities. And by investing activities, it's the investments that you make. So some of the investments that companies make would be such things as purchasing new equipment, purchasing fixed assets, and these assets will generate profits over their useful life for the business. So the business, if you purchase an asset, guess what? You're paying. So it means that your cash is going to reduce. It's going to be a negative flow of cash. If you sell out an asset, then it's going to be a positive cash flow. However, you do not want to be, or business should not be selling out all its assets, because it's going to run into problems. If you sell out all your assets, well, how are you going to use motor vehicles to transport your goods? Where are you going to operate from if you sell out your building? Okay, but there are times when the business would find it necessary to probably replace an asset with another one, and they would sell that out. But yeah, that's why we said the operating activities is what is the most essential. And That is how the cash flow statement views it. So if you purchase inventory, your inventory increase, what does that say? It means that you have tied up cash in inventory. You have purchased inventory and this stays on your shelf, okay? And until that is sold or converted into cash, it's going to stay there. So any increase in inventory is seen as a negative effect on your cash flow. It means that you have less cash at your disposal because you have spent it on buying inventory. The bookstore bought books, they're sitting on the shelf, and that is cash that is tied up. If you have increase in receivables, as we said, if the bookstore constantly gives on credit, makes its sales on credit, well, yes, the people would pay, but you don't actually have cash in your hands. And so as your credit sales increase, you're tying up your cash in the hands of your customers. For trade payables, it's the reverse. The more things that you can buy on credit, well, that is a way of increasing your cash amount. That means that is a way of borrowing from your supplier, so to speak, so as to lessen the burden of tying up your cash, okay? And so that is what the cash flow statement does. It monitors the trend between the different assets. So if your inventory increase, it means that that's a negative impact. If the inventory decreases, it becomes positive. The third area of the cash flow is the financing area. And that's where we speak about things as acquiring a loan. So if you acquire a loan, it means you're getting money, money is coming in. If you're paying the loan, money is going out. So the cash flow is measuring, the cash flow statement is measuring the trend or the activities that are taking place in these three areas. As I said, the greater concern is going to have to be with your operating activities to ensure that these operating activities should be where you're generating most of your cash, okay? As you see with the cash flow statement for the bookstore, in our illustration, that there is zero cash flow movements for investment activities, which tells us that the bookstore did not purchase or sell any assets in the last 3 years. But we see that there is some activity happening in the operating activities, very healthy. And we see in the financing activity, we see that there is a negative cash flow. It means that the bookstore is paying back, it's repaying back the loan. Is that a bad thing? No. But as long as there is enough positive cash flow from its operating activities to finance the payment of its loan, it should be in good order. Okay, so that's what the cash flow tells us. It shows us how the movements between our assets and our liabilities are as it relates to cash. But remember that cash always triumphs over profit. Okay, so that is why it's very important. Even if you're making sales, but you have to ensure that you manage your cash properly to meet your immediate debt, okay? And just before we move on, normally you need to hold cash for day-to-day operations. You need to hold cash to speculate in the event that an opportunity arises to make an investment. You also need to hold cash for precaution reasons. There might be an unforeseen expense that your business might run into. So it's always very important to pay attention to your cash flow statements, see how these various activities are and where you need to improve on your cash flow statement. Later, I believe we have 2 more polls, and after that there are no more polls. So let's just see what we have gotten from the cash flow statement.
Yes, so can you see it right now?
No, maybe my screen, maybe I'm not sure if it's my, but that's okay.
It's launched already, and as soon as we have the first response, I will share with you.
Okay.
The first question, from which activity does the bookstore generate the most cash? And the second activity, well, the options are investing activities, operating activities, financing activities. Then the second question asked, okay, someone responded, so for sure, Participants have seen it. The second question, choose the statement that you think best reflects the cash flow of the bookstore. The first one says the bookstore has been purchasing and selling fixed assets over the last 3 years. The second, the bookstore uses working capital and long-term debt to generate cash. And the third one, based on the 3-year trend, the bookstore may run into cash flow problems in 2020. So we already have 3 responses. We would look for about 15 if possible. We hope that at least 15 of our participants would respond. We have 7 respondents now.
Okay.
So we have 9 respondents now. 10, doing very well. Keep them coming.
Oh, we're progressing.
We have 11. I think we're just with a few more seconds.
I believe we're almost there.
We have 14. One more person, almost there. We have 15 now. So I will end it. Excellent. And I will share the results. 16. Good one. Thanks for coming in there, the last person. And are you seeing the results, Elijah?
No, I'm not, but you could just read for me.
So from the first question, the most popular answer, 81% of the respondents responded that operating activities is the activity that generates the most cash. And then we look at the second question in terms of the statement that best reflects the cash flow of the bookstore. 63% of the respondents chose the second statement, which says that the bookstore uses working capital and long-term debt to generate its cash. We had 19% for both the other statements, which says that the bookstore has been purchasing and selling fixed assets over the last 3 years. And 19% also responded that based on the 3-year trend, the bookstore may run into cash flow problems.
Okay. All right. So if we look at the first question, which activity generates the most cash? If we look at our cash flow statement, as majority got it right, it's our operating activities. The operating activities is where the cash flow is generated more than any other activity. And that should be the normal for any company. It is your day-to-day operations that should be generating your cash. If another activity is generating more, like for example, selling out of your assets, then that's going to be a very big question mark. It's going to be, are you closing down your business? Why are you selling out all of your assets? Or if it's your finance that generates the most cash, it means that you're going to be selling a lot more of your ownership, giving up a lot more ownership of your business so that investors can buy in. And that is a big level of concern because it means that you are going to probably be bought out of your company. So it's always, the safety net is where your operating activities is always the bigger generator of cash than the other two. And for the final question, if we look here, it can tell a story for us, and the story tells us is that I think majority of people got it right, that the bookstore is using working capital and long-term debt to generate its cash, and that is correct. as we can see, the two areas that cash is generated is on the operating activities where our working capital comes from, and also from our investment where we see our loans and so. Okay, some thought that there will be cash flow problems in 2020, but if we look at the trend of the cash, if you notice the cash balance at the bank every year, it is increasing, and it's increasing substantially. So if we were to assume that the bookstore was to remain operating as it's doing in that same trend, we are going to expect that it's going to generate even more cash come 2020. So definitely it would not have a cash flow problem in 2020. Okay, this is where I can finally see the poll, I'm not sure. Yeah, I can finally see this now.
Okay, great.
Okay, all right, so we're just wrapping up. Right now, I just want to share this slide. This slide here shows us, yes, Lizra, you're on the right one.
Which one, this one? That's...
No, the one of the income statement. Right, this one. So we looked at our income statement, and one of the ways to really have a quick visual of what's happening, this is a perfect reflection with what we were looking at. We were looking at the figures and numbers, but this now shows us in a pictograph what the performance is over the 3 years as it relates to the income statement. The green columns represents revenue, the red represents cost, and the gold represents the amount of profit. And as we can see, for the years, we have always been selling more than we have been spending, which is good, and our profits are growing. That helps tells a picture. So you might not want to burden yourself with all the details, but when you're presented with a report from your accountant that shows those trends, then you can understand what it's saying to you right there. You can look and compare. As you can see, every year that the green column is getting taller, which means that your sales are increasing. Although your expenses are increasing, and they should, because there's a direct correlation between revenue and purchases. As you sell more, you need to buy more so that you can sell more. But the good thing is that we are always operating at a profit. Okay, all right, so just to wrap up, we're going to look at the 5 key areas of financial statements. 1, financial statements must be accurate. Accuracy is very vital. And that means transactions must be recorded correctly. So we're going back, touching base on our bookkeeping. So in doing our bookkeeping, it has to be accurate. We need to get it correct. And remember, in getting it correct, we need to analyze it, make sure that it's measurable. We also need to consider the accounting equation. We also have to think of the classification of the account, and we also have to do the right debit and credit, and that will get us to do it correctly. We also have to pay attention to details for particular values, okay? Pay attention to the correct value. That is very important. If a company is recording its assets, it must ensure that it is recorded at the correct value. Completeness is also important. Those of you who are not keeping records, it means that to generate a financial statement for your business, an accountant would do an assumption and would have to state that you have incomplete records or no records at all. And so it's more of a guesstimate of your statements. You do not want to have a guesstimate. You want to have actual information. Your bookkeeping record should be as realistic to reflect the actual actions that occur. So when we speak about completeness, you have to ensure that all transactions must be entered. If you spend $5, it's as important as if you spent $5,000. Doesn't matter how significant the value of the transaction might be to you, but everything should be recorded. Completeness also deals with relevance in terms of having the relevant supporting documents to provide information for your persons. Another component is being relevant in that the transaction must be entered in a timely manner. So having your bookkeeping done timely is important. If you need to generate a financial statement, you must have it as up to date as possible. If you're going for a loan, to access a loan, the bank is going to expect you to at least provide financial statements for at least December 2019 and not 2017, because by then this information is not relevant. So many things have transpired between 2017 and now. So this is why your bookkeeping have to be done timely, okay? And the information must also provide significant details so that the user can understand what's happening, okay? And that is where, for example, if you purchase a computer and you're entering it into your book, you must give detail of the type of computer, even the serial number, that sort of thing, to help reflect proper information into the system. There should be true representation. What we mean by that is that the information must represent actual activities. So it should not be fictitious, it should not be made up. Some persons might want to get a loan and they might want to inflate or exaggerate their sales, their revenue. Just because you want a loan, you might want an accountant to create some, some sort of records that does not reflect the true picture of your performance. And that is very dangerous to do because you're putting yourself and your business at risk. So let your information be a true reflection of what the business is doing. And to do that, to have a true reflection, that is where your record keeping and maintaining all your source documents so that it can be edited, it can be analyzed, so as to determine the true transaction, okay? The last one, comparability. As you saw in our illustration, preparing financial reports is good. Presenting just 1 year financial statements does not give a holistic picture of the performance of your business, because your business could be profitable in 2019, but it could have been making losses for the last 4 years. And so having information that can be compared over time is important. Also, if you notice, the financial statements that we looked at in our illustrations were very systematic, were very structured. And as you notice, from year to year, wages, utilities were on the same line. There was consistency. Because you, in comparing or reading out financial statements, you want to ensure that they're presented in a way that the user can follow and can follow without any distractions or confusion. And of course, the transaction must be entered using the same method, as I said, year to year, okay? So these are the basics of financial statements. And understanding the impact now of the bookkeeping. So we said the bookkeeping is the foundation. It is the raw ingredient as you speak. So whatever product you're making, think of bookkeeping as that raw ingredient that you transform and you convert now into the finished and final product, which is your financial statement. So if you want quality, you're going to have quality ingredients. So you want a quality, realistic, accurate, complete, relevant, true, and comparable financial statement. You need to ensure that your transactions are entered according to the bookkeeping processes of analyzing it, ensuring it is done according to the accounting equation, ensuring that you classify it into the right accounts, and ensuring that it hits the debits and the credits on the right side of these accounts. So we have come to an end of our presentation and training today. I certainly hope that this has helped you to have an understanding of why the importance of bookkeeping and also the elements of financial statements. I'm hoping that those of you, the 11% of you who never did bookkeeping, that you're going to start doing so. And those of you who said that you do it sometimes are going to commit to do it all of the time. At this time, thank you for your participation. Over to you, Ms. I think your mic is muted, Lisa.
Oh.
Yes. It's muted again. Okay.
Yes, it's there now. Great. So thank you, Elijah, for this great presentation, for sharing with us on record keeping, the importance of financial statements and the importance of record keeping. From the feedback thus far from the attendees, I could see that it was very valuable for them. And for this, we're really grateful for your support. I would like to do one more poll. The last time we did the poll through the Google documents, but seeing that we have the participants here right now, we'd like to share this final poll with you so that you would be able to give feedback on how the session was for you so that we can continue to improve. So I'm launching a poll now where we could understand from you how valuable was this session, with 1 being very dissatisfied and 5 being very satisfied. We look at the course content, delivery of content, relevance of content, ability to apply the course content to your daily operations. So it's just 4 simple questions, and we look forward to you completing this poll now so that we can continue to improve on this for you. We're really delighted that you've stayed here till the end at 6:43, and we look forward to your feedback. Thus far, we've had 4 persons responding, 4 out of 22.
That's good.
And we're hoping that we can reach 15, at least 15, like the other polls. I saw, meanwhile, while we are waiting for the responses, there was a comment in the chat which referred to the concerns on the last exam.
Okay.
So we look forward to continuing to improve that as well. We'll work along with Brent so that we can ensure that all your concerns about the exams are addressed. Okay, so we're seeing the interactions thus far. Exceptional presentation, Elijah. Thanks and great presentation. The interaction was very valuable. Thanks, exceptional. And we look forward to making it more interactive and very useful for you. I see this time we had a lot more participation. So we look forward to continuing to engage you through the poll. If there are any suggestions that you have as to how we can improve the last section, we look forward to do just so. And just a suggestion for the poll, we should have at least 5 at the top being very dissatisfied and the not satisfied at the bottom. Okay. Thank you very much for that. So thus far we've had 16 respondents ending the poll now, and I'll share the responses. So thank you very much for being very satisfied with the content, with the delivery of the content, with the relevance of the content, and the ability to apply the course content to daily operations. For those of you who indicated that you want to start a business, we hope that you will be able to use all the tips that's shared so that once you start your business, you can start off on the right foot. Just to remind you that we'll make the video presentation available, the presentation that Elijah shared also available, and the quiz on one article which would be shared, or one link which will be shared, so you can have access to everything in the same place. So thank you again, everyone, for being present at this, and tomorrow we'll ensure that you have all the necessary documents to support you in completing the quiz. Elijah, once again, thank you very much, and we wish everyone a pleasant night.
All right, thank you, everybody.